Friends, today's topic is SEBI's new Valuation Rules 2024-25 that has changed the corporate finance game. This material was authored by Dr. V.V.L.N.Sastry based on secondary research. Dr. Sastry is a financial economist, jurist, and international arbitrator. My name is Ms. Georgia, and I am his AI assistant narrating the topic to you all. In the Indian corporate world, we are witnessing a silent but powerful shift. SEBI has tightened valuation regulations like never before, affecting sweat equity, preferential allotments, share swap mergers, and even IPR-based transactions. If you're a promoter, investor, CFO, merchant banker, or registered valuer, the rules of the game are now different. Today, I'll explain SEBI's new valuation regime for 2024 to 2025, why stock exchanges like NSE and BSE are raising tougher queries, and how companies must adapt. Now let us get into the topic, friends. Why SEBI tightened valuation rules in 2024 to 2025? SEBI noticed three major problems. Over-optimistic projections. Companies using unrealistic revenue and EBITDA projections to justify higher valuation. Conflicting valuations. Merchant banker versus IBBI registered valuer reports showing different values for the same company. Opaque methodologies. DCF, PECV, market price method being used without proper assumptions, disclosures, or cross-verification. These issues directly affect minority shareholders and have led to inflated pricing in preferential issues, sweat equity, and share swap deals. So SEBI responded with something unprecedented, a complete tightening of valuation norms starting 2024, continuing into 2025. Key features of SEBI's new valuation expectations. Dual valuer scrutiny. Merchant banker valuation isn't enough. Stock exchanges now require IBBI-registered valuer reports to independently confirm assumptions. Assumption transparency. Both valuers must disclose growth rates, working capital cycles, risk-free rate and equity risk premium terminal value logic, sensitivity analysis, normalization adjustments. Anything hidden, NSE BSE raises immediate queries. Projection realism. Check. Exchanges now compare past 3-year performance, latest Q2Q results, peer multiples, sector stress indicators. If projections look inflated, the valuation is rejected. Forensic valuation signals. SEBI has quietly begun assessing related party anomalies, unexplained receivables, asset impairments, inventory cost, mismatches, CAPEX claims without actual assets. This is part of a new anti-manipulation, anti-inflation regime. Impact on corporate actions. Sweat equity issuance. Sweat equity now requires robust value attribution to the person receiving shares. Merchant banker plus RV must justify how the sweat contribution was valued, what IP, know-how, or strategic contribution is being priced, why the issue price reflects fair value. Preferential allotments. Pricing guidelines have become very strict. Even minor inconsistencies in WC cycle, EBITDA margin, or cost of capital leads to exchange queries. Share swap valuations. For mergers, acquisitions, two companies must now be cross-valued on consistent parameters. Any mismatch, SEBI demands reconciliation. Bottom line, Indian corporates can no longer use aggressive valuation models to justify premium share issuance. Now let us look at merchant banker versus registered valuer conflicts. This is the most sensitive area. SEBI noticed that merchant bankers often rely more on market data plus projections. Registered valuers focus on assets, past performance, and net worth. So their valuations differ. Earlier, this was tolerated. Now it is not. For 2024-25, both valuations must converge or a strong reconciliation statement is mandatory. Discrepancy without justification. Exchange rejects the application. Why NSE BSE queries are becoming stricter. stock exchanges are now the first line of defense. Their queries revolve around EBITDA, mismatch change in debtor-creditor days, typos in financial sheets required normalization adjustments, DCF assumptions versus actual performance, whether projections consider industry realities, why two valuers gave different numbers. This is the new normal. What companies must do now to survive the 2024-25 tightening. Prepare clean, audit-consistent financials. Ensure both valuers share baseline assumptions. Use realistic projections backed by sector data. Address forensic red flags proactively. Respond to exchange queries with clarity and evidence. Maintain full documentation for sweat equity, IPR valuation. This is essential for promoters, CFOs, and secretarial teams. To conclude, SEBI's message is clear. Transparency is non-negotiable. Valuation discipline is now the backbone of India's capital markets. For companies that are honest and well-prepared, this is an opportunity. For companies trying to push aggressive valuations, the era of free pass is over. Thanks for your patient listening, Jai Hind.